Alrighty guys, you saw the title of the video today. We have to go over the harsh reality of bear market rallies, which if you guys didn't know, right now we're rallying within a bear market. So we're in a bear market rally right now. Let's go over the harsh reality of bear market rallies. So I was reading an article, I think it was on Bloomberg, and we'll talk about it and jump into that article here in a second, which really sparked this video, the video that you're watching right now. So we're going to break down again the harsh reality here and the fact that we see many, in terms of history here, we've seen many sharp V-shaped rallies within bear markets that did not last, that fizzled out. So let's get into it. If you guys find value, hit that like button, subscribe, and join my Patreon if you want. Now's the best time to do that, the beginning of the month. Check it out, link down below. And with that being said, cheers, let's get into it. So we all know at this point in real time, in the time period we're living in right now, and don't worry, we're going to talk about 2000 and 2008 in this video. Right now, we are in a bear market, right? We have the NASDAQ going. It peaked at about 16.7, and then it went all the way down to about 11.4 just a couple of days ago, about a week ago, which means it went from top to the bottom that's in right now. We don't know if this is the bottom, but the bottom that's in right now, it is down over 30%, right? Or it did go down at one point over 31% to be exact. We have the S&P 500 from top to bottom, 4,800 to 3,800. This thing went down 20%, so just slightly in a bear market. And we had the Dow Jones Industrial Average from 36.9 to 30,600, that is, guys. This didn't even go in a bear market. It only went down 17%, as we had the Russell 2000, the small caps. This went down about 31%, pretty much the same as the NASDAQ. So before we talk about and look at the charts here from 2000 and 2008, let's dive into this article, which I do believe, again, it's a Bloomberg article. Let me double check that, and I don't pay for Bloomberg, guys, so we're going to have a lot of ads, so I do apologize for that, but who cares? We're still going to get the message across in this video. So let's get into it. So this article starts out like this. So if tempted to try buying the dip, take a look at how the great sell-offs of 2000 to 2003 and 2007 to 2009 unraveled. They saw peak to trough falls in the S&P 500 of 49 and 56% respectively, but like I've said, there were plenty of rallies on the way. After the dot-com bubble, Larry McDonald of the Bear Traps Report LLC points out that the NASDAQ Composite, center of the speculation, which during this go-around in 2020, a lot of those unprofitable, high-growth stocks were the center of speculation as well. Aren't they always, guys? These saw counter rallies, counter trend rallies, the NASDAQ did, of 22%, 24%, and this is counter trend rallies. In other words, guys, this is rallies within the bear market, right? And let me double check if you can see this. Let me move my face. Actually, I'll keep my face right down here. There we go. So this saw the NASDAQ did counter trend rallies of 22%, 24%, 37%, 18%, 22%, 30%, 47%, and 56%. So that means during the bear market, it rallied up those percentage, it rallied up multiple times over 20%, sometimes over 40, 50%. This is unbelievable. And each time it looked like the downtrend was over, it wasn't over. It was not over, guys. And the S&P 500, according to the this article here by my count, which is not my count, but the person that I guess wrote this article, the S&P 500 had 12 rallies of at least 6% from top to bottom. And this chart right here, I don't know if I could expand it. Oh, I can expand it. Can you guys see that expanded version? Oh, you sure can. Look at that. Look at that, guys. This shows you all of these rallies within the bear market, and each time, if you bought the rally thinking, oh my God, this is the bottom, we got to get in on this rally, you would have got hit each and every time until, of course, it actually was the bottom, which we'll take a look at that chart here in a second. So this goes to show if we have a huge rally within the bear market, you got to be careful. Do not load the boat, go all in, and try and time the bottom, because history proves that, yeah, we got a lot of bear market rallies, guys. So let's go back and see, and mind you, this is for the NASDAQ, right? Let's see if we have one for the S&P 500 on this on here. Yeah, this is the S&P 500. Look at all those rallies, guys. You got an 11% rally, a 12% rally, 7% rally, 24% rally, and they all ended up being bear market rallies, guys. So let's now dive back to the charts. ThinkOrSwim, again, shout out for shout out to Bloomberg. They're not sponsoring the content, guys, but they did. This article on Bloomberg, shall I say, did spark the idea for this video today. So let's go back to the charts so I can show you more in depth how many times we rallied during that, crisis in 07, 08, or early 2000s. And we'll go over what's going on today, guys. So let's go over here to the NDX, which is the NASDAQ 100 index. And that's not to be confused with QQQ, which is the ETF, right? And they essentially, QQQ tracks the NASDAQ 100, but don't confuse the two because they are technically different. I mean, one's an index fund, one's an ETF, but we're not going to get into that in this video. So if I zoom in, let me make sure you guys can see this. You sure can. Look at this. This is the dot-com bubble, right? This is where we saw a huge rise in the late 90s, 96, 97, 98, 99, all the way to 2000. March of 2000 is where it peaked. This thing went from 900 points, 800, 600, 700, 800 roughly, all the way to almost 5,000 points in a couple of years. We're talking hundreds of percent increase. I mean, this is insane. 6, 7, 800%. And I do think fundamentally we are way different right now than the dot-com bubble. Mind you, a lot of companies in the dot-com bubble were pre-revenue. They were pretty much worthless companies that were going and they were pumping. At least the companies that were pumping this go around, they were pretty good businesses. Some of them were. Obviously there was a lot of garbage that was pumped as well, but it's a little bit different. You guys know what I mean, but we're not going to get into that in this video. What we are going to focus on is these rallies. Look at these rallies, guys. So if you, let's say, I'm sure there's people out there that when the dot-com bubble burst officially, but obviously in the time you didn't know, when it peaked at 4,800, the NASDAQ 100, and it went down to about 2,900, that was a drop. And that was in the first couple months, guys. That was a drop of 40%. We're talking in just 2 months, it dropped 40%. And then it started rebounding from 2,800 all the way back to 3,500, 4,000. People were like, oh, the show's still on, guys. The show's still on back then. That's what people were probably thinking. And then lo and behold, we hit a lower high here at 4,140. The all-time high, or at that point, the high was 4,800. We hit a lower high, and that's where the real treacherous bear market began. So if people bought this dip, I'm sure people bought this dip in July, June of 2000, over 20 years ago at this point. I'm sure people bought that dip. And then we had the NASDAQ go from 4,000 all the way down to 7,800, which is crazy. The low on the NASDAQ during that time period was roughly 750, 800, which is just unfreaking believable. And during that big drop, we had many time periods. In December of 2000, we had another relief rally of about, you saw the chart earlier, so no need to go too deep into it again. But we had so many rallies, right? Same thing with the S&P 500, but obviously the rallies weren't as crazy on the S&P because it was a dot-com bubble, mostly for, the tech stocks. So the NASDAQ was way more volatile, way more crazy. But the S&P did have its fair share of, bear market rallies. So you can see it here, boom, on this chart from the early 2000s and from 08. Look at this. In 08, we had many, in 07, 08, 09, many rallies, actually mostly 07, 08, within the bear market. So where are we today? Let's wrap it up to where, wrap back to where we are today. Am I saying that this is a bear market rally? What we're seeing right now, as SPY's gone from 380 to about 409, it's rallied 8-9%. Triple Q's gone, let's see here, from 280 to about 308. It's rallied probably over 10%. Yeah, about 11%. This could very well be a bear market rally, guys. It could easily be a bear market rally. And quite frankly, I think it is. I'm going to be completely honest with you guys. And I said this when I was calling for the rally 2-3 weeks ago. I said we're way oversold. When we went through April and when we went through May, which May was a rough month as well, when we went through those 2 back-to-back months, I was telling you guys, look for the rally. But the bear market is most likely not over, and I'm still sticking to that. I don't think this bear market's over. I'd be shocked if we went to all-time highs. I think we might start getting some selling pressure. I still think we could start moving towards 330 on triple Q, but if we get extended towards 330, maybe 340.50, if it does end up getting there, which I don't know if it will, guys, to be honest, but if we start getting there, don't be surprised if people start shorting the markets at that point. We start getting some, a lot of puts being bought, because at the end of the day, history shows during bear markets, and we're still technically very extended historically speaking here if you look at the charts, during bear markets, we get these rallies, people get sucked in, and then we end up selling off aggressively again. So you got to be very careful here, in my personal opinion. And does that mean don't buy stocks at all? Let's end it off here. Does that mean don't buy stocks at all and wait till the bottom? No, guys. Do not make that mistake. Even though we saw the charts, there are many bear market rallies, and we're likely to go lower from here. Seriously, we might go lower from here. You should not stop buying. The idea here is to continue to dollar cost average throughout the entire freaking bear market, no matter how long it lasts. And then when it recovers, when we have the next bull market, you continue dollar cost averaging. If you're taking the approach of long-term investing, index funds, ETFs, set it and forget it, you buy all the time. In the bear market, as it goes down, as it goes up. And obviously, if you're an individual stockholder, you're more active, and maybe you like ETFs as well. You have a blended approach, which is what I do. And you trade, you do options, you kind of do everything. Then you could be a little bit more, there's nuance to it, right? Then you could be a little bit more involved. I would still say, and this is what I do as well, continue dollar cost averaging with your long-term ETFs, but with your short-term stuff, you can have a little bit more fun, right? You can try and, maybe not time the market as a long-term play, but, you can trade, you can do your little options. That's what I do, obviously. I trade, I make money from the stock market short-term, then I take that money, reinvest it long-term. Obviously, I take some money out, live off the money, and so forth. That's one source of income that I have. So at this point, I'm just looking at individual stocks. Obviously, as we get lower in the indexes, the individual stocks get cheaper, and I've been buying a couple that I like here, and I will continue buying more as those individual stocks, if those individual stocks go down even more. And again, I'm just going to be buying index funds, no matter what the markets are doing. And I would like to buy index funds in a bear market, because although you might think stocks going down is bad, it's not bad, guys. It's good. You're actually getting at stocks at a cheaper price, and that means you getting to your financial goals. You will get to your financial goals faster by getting stocks at better valuations, right? So we'll wrap it up there. Cheers. Thanks for watching. As always, guys, let me know your thoughts in the comments. Hit that like button, subscribe, join my Patreon if you want all my buy, sells, call outs, morning videos, all that good stuff is linked down below, and now's the best time to try it out, check it out. Again, join that, and if you don't like it, you can just cancel it, and then boom, you don't get charged anymore. That simple. And don't forget to get your free money from Moomoo and from Webull. They're still running some promos down there. Get your free money. And with that being said, cheers. I'll catch you all in the next video tonight. Peace out, guys.